The German middle class of 1923 did not lose their savings because they were reckless. They lost them because they owned exactly what every financial advisor, every bank, every respectable institution had told them to own: the house, the insurance policy, the furniture, the luxury goods, all of it purchased carefully, responsibly, with decades of discipline. All of it rendered functionally worthless inside 18 months. That is not a cautionary tale from a different civilization. That is a documented pattern. And it has repeated with near-identical asset categories in Argentina in 2001, in Venezuela in 2016, in Cyprus in 2013, and in Weimar Germany in 1923. The same 5 purchases, the same 5 collapses. Different flags, identical outcomes. This is Economic Historian, where we decode the financial decisions that quietly shaped the world you live in today. In the next 11 minutes, 1. The single most dangerous purchase an educated professional makes before an economic collapse, and why it is dangerous precisely because it appears intelligent. 2. The financial product that 5 separate governments have quietly liquidated from their own citizens' accounts during monetary crises, and what it was replaced with. 3. And this is the part that almost no modern financial commentator discusses: why the timing of these purchases matters more than the purchase itself. Because the same asset that protects you at one point in the economic cycle destroys you at another. And the signal that tells you which phase you are in has been hiding in central bank meeting notes for 30 years. There is a pattern that surfaces in every documented economic collapse. Not a pattern of poverty. A pattern of preparation gone wrong. The people who suffer most during systemic financial crises are rarely the people who made no preparation. They are the people who made the wrong preparation, who purchased the assets that appeared stable, then discovered that stability itself is a feature of economic conditions, not a property of the asset. To understand why certain purchases survive, collapse, while others evaporate, you have to understand one mechanism: the difference between assets that store value in trust versus assets that store value in scarcity. When institutional trust collapses, and in every documented economic crisis, that is precisely what collapses first: any asset whose value depends on a functioning system of enforcement. Liquidity or social consensus becomes immediately vulnerable. The 5 purchases on this list are not random. They are the 5 categories that appear with alarming consistency in the post-mortem accounts of every documented economic collapse. And they are the 5 categories that financial institutions, right up until the moment of crisis, actively encourage their customers to hold. That last detail is not incidental. It is the mechanism. The first purchase is mortgaged property in the wrong location. Think of a mortgaged property like a lever, except the lever is attached to a weight that can be adjusted by someone who is not you, without your knowledge, while you sleep. The asset, the house, may retain physical value. The purchase, the leveraged debt instrument attached to it, does not. In the United States, between 2007 and 2010, median home values in exurban markets fell 47%. The houses did not disappear. The debt remained. The gap between those two facts destroyed 3.8 million households. In Argentina's 2001 collapse, the pattern was more extreme. Mortgage contracts were denominated in US dollars. When the peso was devalued by 75% overnight, the debt still calculated in dollars became 3 times larger relative to income. Property owners who had bought responsibly, who had maintained payments, who had done everything correctly, found themselves holding a liability 3 times the size of the asset securing it. This was not accidental. The architecture of dollar-denominated mortgage debt was created by the banking sector and encouraged by the IMF as a condition of Argentine economic participation. The internal projections, declassified in 2004, show the distributional effects were modeled in advance. The property was not the problem. The purchase, specifically the leveraged financial instrument wrapped around it, was the instrument of wealth accumulation that became the instrument of wealth destruction. This was not about protecting homeowners. It was not even about managing monetary policy responsibly. It was about maintaining a system where debt creation remained profitable regardless of whether the underlying asset held value. Because once you control the denomination of the debt, you do not need to control the asset. You only need to control the currency. The second purchase is the luxury vehicle. A new vehicle loses between 15% and 20% of its value the moment it leaves the dealership. This is known. What is less discussed is what happens to that curve during monetary contraction. During the 2008 financial crisis, used vehicle auction prices in the United States fell 30% between September and November of that year, 11 weeks. Vehicles purchased at full price in 2006 and 2007 were being sold at auction for less than half their purchase price by 2009. Simultaneously, fuel costs spiked. Insurance costs, tied to credit conditions, rose. The monthly payment fixed consumed an increasing proportion of shrinking incomes. In Venezuela between 2016 and 2019, vehicles became near worthless as a function of hyperinflation, not because nobody wanted them, but because replacement parts, fuel, and insurance had become impossible to price. The asset itself existed. Its utility evaporated. This is the mechanism that almost no financial advisor explains during economic collapse. The cost of operating an asset frequently outpaces its resale value. The purchase becomes a liability that cannot be shed because the market for it has simultaneously contracted. Nothing says investment strategy quite like an asset that costs more to maintain each month than it is worth on the open market. And yet, in the 18 months preceding each of the 4 crises referenced in this video, vehicle sales in affected markets hit multi-year highs. The population was purchasing depreciating liabilities at record rates precisely when the underlying monetary conditions made those purchases most dangerous. The third purchase is whole life insurance and annuities. This is the purchase the 1920s German middle class made most faithfully, and it is the one that hurt them most completely. Whole life insurance policies and annuity contracts are debt instruments denominated in currency. They do not store value. They store a promise denominated in the prevailing monetary unit at time of payment. In Weimar Germany, insurance policies accumulated over 20 years of disciplined monthly payments were paid out legally, contractually, correctly, at face value in 1923 Reichsmarks. By November 1923, a payout of 1 million Reichsmarks would not purchase a loaf of bread. The insurance companies had fulfilled every obligation. The currency they fulfilled it in had undergone asset devaluation of 4.2 trillion%. This was not theft in the conventional sense. The legal architecture performed exactly as designed. It is simply that the design did not account for, or in some readings of the archival record, was indifferent to the scenario in which the denomination itself ceased to function. Cyprus in 2013 updated this mechanism. Deposit insurance was set at 100,000 euros. When Cypriot banks were restructured, deposits above that threshold were subjected to a levy of up to 47.5%. The legal architecture, again, functioned precisely as written. What was purchased, the protection did not survive contact with the crisis it was designed to address. The pattern across both events is identical. The product was sold as security. The fine print defined security in terms of the system's own continued functioning. The moment the system required rescuing, the security dissolved. Because the institution selling the protection and the institution requiring the rescue were, in both cases, the same institution. The fourth purchase is investment-grade collectibles, high-end watches, fine art, rare wine, premium handbags. These entered the mainstream investment conversation after 2010. The logic appeared: sound, scarcity, global demand, non-correlation with equity markets, asset class diversification. The mechanism that destroys them during collapse is not scarcity. Scarcity remains. The mechanism is liquidity, specifically, its disappearance. In economic architecture, liquid and illiquid assets are not different in degree. They are different in kind. During Argentina's 2001 crisis, my Rolex Submariner that had traded at $4,000 equivalent the year before could not find a buyer at 800. Not because nobody wanted it, because nobody had access to functional currency to purchase it with. The market for luxury collectibles requires, as a baseline condition, a functioning monetary system with accessible credit. Remove the baseline, and the scarcity of the object becomes irrelevant. The investment strategy that performed best during collectible market freezes across every documented crisis was not the rarest item. It was the most liquid item in the most universally recognized category, meaning not the painting, not the watch, not the vintage wine. The pattern across 5 separate economic collapses is unambiguous on this point. Scarcity creates value inside a functioning system. Outside a functioning system, scarcity creates an object that nobody can afford to purchase and nobody will accept in exchange for necessities. The collector becomes the custodian of something beautiful and entirely useless. The 5th purchase is technology and electronics bought at peak price. This one is counterintuitive, and that is exactly why it belongs on this list. During periods of monetary expansion, which is where most of the Western world has lived since 2009, technology purchases appear rational. Productivity tools, communication, infrastructure, home automation. The purchases align with investment strategy in a growth environment. During economic collapse, the same purchases become fixed costs that cannot be shed. Subscription services attached to hardware, software licensing tied to devices, replacement parts that require functioning supply chains. The product was designed for an economic architecture that assumed stable monetary policy and accessible credit. The moment those conditions change, the product's utility curve inverts. More precisely, the value of a technology purchase is not the hardware. It is the ecosystem supporting the hardware. That ecosystem servers, supply chains, software updates. Technical support is built on institutional trust and central bank stability. When that stability contracts, the ecosystem contracts. The hardware remains. The value disappears. The same dynamic appeared in Venezuela after 2016, where smartphones became non-functional not because they broke, but because the infrastructure supporting them, internet access, app stores, data networks, became too expensive to maintain at a national level. The device existed. The service it was purchased to access did not. But here is what almost no economist mentions when discussing asset performance during collapse. The purchases themselves are not the primary error. The timing is. Every single asset on this list, the mortgaged property, the insurance policy. The collectibles has been used at different points in the economic cycle to successfully preserve and transfer wealth across crisis periods. The asset is not inherently destructive. The phase of the cycle at which it is purchased determines whether it protects or destroys. And the signal that identifies the phase has been embedded in central bank communication since 1994. It is publicly available. It is not obscure. And it has preceded every major wealth transfer event of the last 30 years with a lead time of between 14 and 22 months. Today, these mechanisms operate under different names but identical incentive structures. Reichsmark-denominated insurance from 1923 is now U.S. deal-linked pension annuities. In 2025, the currency promise is made at purchase and honored at payout, by which point the denomination may have changed entirely. The Argentine dollar mortgage trap of 2001 is now a variable rate mortgage in a high-rate environment. The debt instrument grows, while the asset value contracts. The Weimaraira collectible freeze is now the NFT and luxury asset liquidity collapse of 2022, scarcity preserved. Market evaporated. The wealth accumulation strategy sold to the professional middle class today, property leverage, tax-advantaged insurance products. Diversification into collectibles is structurally identical to what was sold to the German, Argentine, and Cypriot middle classes before each of their respective crises. What distinguishes the purchases that survive from the purchases that evaporate comes down to one structural question. Does this asset's value exist within the system or outside it? Assets that require the system to function: insurance, leveraged property, currency-denominated instruments. Collectibles needing a liquid market are exposed to system failure. Assets whose value exists independent of institutional trust are not. Different century, identical incentives. This is not ancient history warning us. It is ancient history explaining us. Every financial product sold to you as protection is, at its core, a contract. And every contract requires two things to function: a counterparty willing to honor it, and a system capable of enforcing it. Economic collapse does not necessarily destroy the asset. It destroys the counterparty. It disables the enforcement system, which means the question to ask of any major purchase is not, "Is this valuable?" The question is, who decides this is valuable when the system that currently decides stops functioning? That question, asked before the purchase, not after, is the only framework that separates the German family that preserved its wealth through 1923 from the one that lost everything while holding the same surface-level assets. Every currency is not a store of value. It is a store of trust, and institutional trust, as history demonstrates without exception, always carries an expiry date. This pattern has appeared in 11 documented monetary crises since 1900. Right now, in 2025, the spread between central bank forward guidance and actual monetary policy implementation has reached a divergence, not seen since 2006, the last time that signal appeared at this level. 14 months later, 3 of the 5 purchases on this list began their destruction cycle. Next, I will show you exactly which asset categories institutional money moved into during each of those 11 crises. Because the flow of institutional capital before a collapse is the only financial signal that has never been wrong, and it is happening again in plain sight in publicly reported data right now.